Welcome to the JWell CFO Show, where we help creative firm owners understand and improve their financial management. Are you in over your head with debt and don't know how to handle it? Or have you been avoiding debt like the plague, but you've always wondered about all those points and rewards you could have been earning? Or maybe how debt could help your cash flow throughout the month? Hi, I'm Jeremy Wells, CPA, and I've worked with many creative entrepreneurs through my firm, JWell CFO, who struggle with managing their cash flow. In this episode, I'm talking all about responsible debt management in a creative agency, and particularly how it affects your cash flow. So join me for some practical tips and insights on how to manage your cash flow and debt like a pro. So when and why would you use debt in your agency? Benjamin Franklin said, if you want to know the value of money, try to borrow some. When you look at how hard banks and financial institutions work to sell debt, credit cards, lines of credit, mortgages, reverse mortgages, it's really telling how big a role debt plays in our economy. Think about all of the advertisements, all of the commercials you see with big name celebrities, big stars, trying to sell you credit cards, mortgages, reverse mortgages. Let me preface this entire episode by saying that I generally prefer no debt over debt. If you don't need to be in debt, then I don't think there's a good reason to get yourself in debt unless you have a really compelling reason and you've done all of your homework, all of your due diligence to make sure that in that particular instance, debt is the right move for you. If you don't need debt, avoid it. Keep in mind that creditors come before investors and owners in terms of getting their money back. So when it comes time to pay bills and funds are short, creditors get paid first. And if things really go south and the business has to close, creditors get paid first. Keep that in mind as you start taking on debt or as you're looking to manage your current debt in your business. If your business is struggling or short on cash, creditors will get paid first. So there may not be money left over for investors. There probably won't be money left over for you either. There is a time and place for debt if you can manage it properly. Credit can help smooth out cash flow, especially for large purchases or recurring purchases, and expense management, which is a way of using debt in your business to delegate spending authority, can help procurement as your agency staff grows. How do you manage debt in your agency? The number one rule here is to guard your credit diligently. And when I say your credit, I mean both that of the agency and you personally. For most small businesses, business debt comes with a personal guarantee. Most small businesses don't have the collateral or the financial history to make lenders satisfied that debts could be repaid. In order for businesses to qualify for debt, there's usually a personal guarantee. Unless there's significant machinery or real estate or a brand name that's been around for a century involved, most of the time that debt requires a personal guarantee. So when I say guard your credit diligently, I mean guard both the credit of the business and your personal credit as well. If you take out a credit card or a line of credit or a loan in the name of the business, chances are you've also personally guaranteed that debt, which means if the business fails to repay that debt, that hurts not only the business's credit, but yours as well. That's not only going to make it difficult for you to get credit for the business in the future, but it might make it difficult for you personally to get debt in the future. So if you go to get a car loan or a personal credit card or a mortgage, the fact that your business has credit troubles in its past will probably affect you personally as well. The keys here are to keep track of all of your expenditures, not just your expenses, not just the costs of running your business, but your expenditures, all of your outgoing cash flows. and to create a budget based on those expenditures. Let's start with keeping up with all of your expenditures. Make sure you don't miss any payments or let any debts lapse. Basically, that means don't miss any of your minimum payments. As soon as you miss a minimum payment, you not only get a significant hit on your credit rating or your credit score, but now you might be running up against some debt covenants. And debt covenants are stipulations or agreements that are written into the contract that you have when you took out that debt. The terms that you agreed to might not have been clear, or you might not have thoroughly reviewed them when you took out the debt, but they will be there and in force as soon as you miss a payment, for example. And a lot of times, debt will include a covenant that says the entire principal balance is due when a payment is missed. That's a really bad situation to be in. So if you are about to miss a payment, or if you have just missed a payment, do everything you can to either make that payment, or if you really don't have the cash available, try to work with that lender to extend some options, to push out the deadline, or to arrange a future payment. But that's usually just kicking the can down the road. And worse than that, the problem can often snowball, because if you can't afford the debt payment now, what makes you think you're going to be able to afford it a week from now or a month from now? So you really have to be careful. If you're in debt and you're struggling to make the payments, you really need to start finding a better solution than just passing the buck and kicking the can down the road. Have an accounting system in place that can show you your current short and long-term debt amounts. Now, your short-term debt is your debt that's due within the next year. This is usually credit cards and short-term loans. Lines of credit also fit in here. For longer-term debt, more than a year, such as loans and mortgages, you should have both a long-term and a short-term component to that. For example, if your business takes out a 10-year loan, the first year's worth of principal payments for that loan should be reported as short-term debt. The remaining 9 years should be reported as long-term debt. Now, if you're not sure how that works, then look at the amortization schedule that should have come with your loan. Or if one didn't come with it, make one. It's relatively straightforward to create an amortization schedule in spreadsheet software such as Microsoft Excel or Google Sheets. And you can create that amortization schedule to show you how much of each payment in the future is going to interest versus principal. And the way amortization works is the amount that goes to interest changes with every payment. Because with each payment, you're reducing the principal. Therefore, the principal amount on which we calculate the interest due for the next payment goes down. So there's going to be less interest due for the next payment. But your payment doesn't change. So what ends up happening is for each payment, the allocation between interest and principal changes. In fact, most of the time for a loan that's paid off over time with a set interest rate, and so it's amortized, most of your earlier payments are just going to interest, and relatively small amounts are going to reduce the principal. This is why I usually encourage my customers who can afford it to pay more than their minimum payments, especially early on. That clears out more of the principal and reduces the overall interest cost of that loan. So make sure you understand how much you actually owe and how much of that is owed within the next year and how much of that is owed beyond the next year. Make sure you're accounting for the entire payment in your cash flow projections, but that you're also separating the interest from the principal in your financial reports. This confuses a lot of business owners. You cannot deduct the payment on a loan. You can't deduct the payment on a credit card. When you purchase something with a credit card, You deduct the expense, but the credit card balance itself and paying that off is reducing a liability on the balance sheet. If you were to deduct the credit card payment, that would be double dipping. You would be counting the expenses that you were paying with the credit card once, and then you would be double counting them when you paid off the credit card balance. You can't do that. But what you can do is deduct the interest that you pay on a credit card or a loan or a mortgage. You can deduct that interest, but you cannot deduct the principal portion of the payments. So you need to know for each payment how much of that payment is going to interest versus how much is going to principal. Interest is a deductible expense, but principal repayments are not. Get help from an accountant if you need it to understand this and to see how this works in your own business. The second point here is to create a budget and stick with it. Once you understand how much debt you have and what it's going to cost from a cash flow perspective to service that debt, make sure you factored that into your budget for at least the next year. On a monthly basis, you have a cash flow budget. You know all of the deposits that are going to be coming in, or at least you have a rough projection of that, and you know all of the expenditures that are going to be flowing out. Studies have shown that the body physically responds differently to swiping a card than handing over cash. The body feels less stress swiping a card. It actually hurts less to swipe a card, even if you're spending the exact same amount. Those studies have shown that when people paid cash, they had more of a negative physical reaction in their bodies than when they swiped a card. The lesson here is that we don't feel the hit when we swipe a card. And now we don't even swipe cards for a lot of our transactions, especially for businesses, because we just enter payment information and click a button. And so there's even less of a physical response to that because we're always typing on our keyboards. We're always clicking things with our computer mice. The fact that we're buying stuff by doing that means that we don't get that physical reaction. We don't feel that pain of the cash leaving or the expense being booked. We just consider it part of our normal operation and we move on. This can make it really easy to get in over our heads on spending, as well as taking out debt. It's easier than ever to sign up for credit cards. It's easier than ever to sign up for loans. So when you do that, and it's as easy as punching on a keyboard and clicking on with a mouse a few times, then you're really not having the physical or emotional response to either signing up for debt or cash going out that we really should be having. If we were spending cash or even swiping a card would give us more of a physical reaction than we get when we use a keyboard to make purchases and a mouse to approve them. Make sure you create that budget and that you actually stick to it. Have some accountability. Share your financials with your business partners, with your investors, with a spouse or significant other, a business coach, your accountant. Share those financials with somebody else and go over them periodically to hold you accountable, to keep yourself from going too far into debt, from spending too much, and from losing control of your business's cash flow. So now that you're in control with a plan, with a budget, and an accounting system that's going to help you track your debts and your payments and your cash flow, what kinds of debt are there that you can use in your agency? First of all, everybody knows about credit cards. In particular, business credit cards exist, and some credit card providers have started making products that are marketed heavily towards small businesses. In particular, American Express has quite a few different products. And when I say products, I mean different kinds of cards that you can sign up for through your business. Now, again, most of these have personal guarantees. They're backed up with personal guarantees. So if you overspend on that credit card or you fail to make a payment, That doesn't mean that you can just shut down the business and walk away. Usually, those credit cards have a personal guarantee from you, and so those financial institutions will come after you for payment, even if the business is shut down. So, with a credit card, you get a few benefits. You get convenience. Usually, credit cards make it easier to pay for things than checks or cash, obviously. But even compared to a debit card, they usually have some features that make them a little bit more convenient. There are some security benefits that come with credit cards. For example, if you lose a credit card number or it gets hacked or it gets used by someone who isn't you, then the worst that can happen is they buy some things with that credit card. The credit card company either flags it for fraud or you catch it and you report it as fraud. And those amounts are negotiated back onto your card. Those purchases are marked as fraudulent and they're taken off. Oftentimes with a debit card, if a similar situation happens, the cash is gone and that's it. Most banks will not return cash, or if they will, it's a very difficult and long process to go through to get cash returned to a checking account. So for that reason, if you're making lots of payments, if you're using third-party vendors, then a credit card might give you a little bit of additional security compared to a debit card. You can also look at expense management, which is something I'm going to talk about in a minute if you have employees who you want to delegate spending authority to. Revolving lines of credit from major banks or other financial institutions is essentially a class of products. Credit cards are one of those products under that concept of a revolving line of credit. I'm going to talk about lines of credit separately, but that's essentially what a credit card is. It's a revolving line of credit. You can spend up to a certain amount, the limit, using those cards. They often include rewards nowadays to encourage spending or to encourage using that product, such as points or cash back. Oftentimes, the points or cash back or whatever reward you're getting is an incentive to spend more. There's always a question of whether you would have purchased what you did had it not been for the rewards that you got back. I have some customers who are fantastic at managing their spending. They don't get swayed by the rewards to spend more, but at the same time, their level of spending is getting them and earning them rewards that make it worth using those cards and those products. Some people spend just for the sake of spending more in order to get more rewards, and that is dangerous. That is using money to make some rewards, but you're never going to get enough rewards back to pay for the purchases you wouldn't have made in the first place if you weren't getting the rewards. A lot of these products also charge annual fees. And sometimes you can get through your bank a free business credit card. And if you can, I highly recommend that. Usually those cards don't come with as enticing rewards as the cards that come with annual fees. And usually those annual fees are on the order of a couple $100s to a few $100s a year. So again, you need to be spending significant amounts to earn rewards to offset that annual fee. Otherwise, you're actually losing money by the end of the year. If you pay $200 or $300 to sign up for a credit card and you use it enough so that you're getting rewards back that are $100 or $200 a year, then you're losing money on the deal. You might as well be using either a free credit card product or just using cash. And of course, there's often, and by often I mean always, interest rates if you carry a balance with these cards. Most credit cards, the interest rates are in the teens, if not the 20-something% for a lot of these credit cards. That's going to be on the balance that carries over past the payment due date. Let's say you put $500 worth of charges on a credit card this month and you get a bill that says your current balance is $500. but the minimum payment is only $100. So you make the minimum payment of $100 by that due date for that bill. Well, you've carried over a balance of $400 past that statement due date. So now that $400 is what the credit card company or the bank is going to charge interest on. Now, if your card has 18, 20, 22, 24% interest rate, those are usually stated in annual terms. So if you divide that by 12, that will give you the interest rate applied to that balance that got carried over. So let's say it's a 24% interest rate annually on your credit card, and you had a $400 balance carried over from last month. 24% annually divided by 12 is 2% per month. So on your next statement, you're going to see that $400 balance rolled over, plus whatever charges you made that month, plus you're going to see an interest charge of 2% on that $400, or another $8 of interest. Now that may not sound so bad, but I'm using relatively small numbers here. If it was $40,000, which I've seen before, now you're talking substantially more interest. Or if you roll that balance over month after month after month and it continues to grow, then you really start to see some compounding effects in the wrong direction. You're seeing compounding of interest that you owe, which is not the kind of compounding you want. So be really careful with the interest rates and with any carryover balance on those credit cards. If you can, pay those cards off. If you cannot afford to pay your credit cards off month after month after month, you have a significant cash flow problem, which means you probably have either a business model problem or you just have a spending problem. You need to cut back on your spending in the business. Another way that you can effectively use credit in your business is expense management. If you have employees who need to make business purchases, then you can use an expense management system. There are a few options out there. I prefer one called Divvy, Divvy. What Divvy and these other expense management platforms allow you to do is add budgets for different line items. Think about the line items on your P&L. You could have a different budget for advertising and marketing, for office expense, for supplies, office supplies, whatever different line items that you're spending money on, you can set up and create different budgets for that. You can also create cards, especially virtual cards. I really like this for managing subscriptions. You can create a virtual card, which, as far as the services you're using and signing up with online are concerned, is every bit as good as a physical card. You have the 16-digit number, you have the expiration date, you have the CVC code. It's in either your name or an employee's name, and you can use that card to sign up for those subscriptions or buy those products. This is especially good for protecting the rest of your cards in case a vendor is hacked or that credit card number is stolen. This allows you to shut down that one credit card while not affecting all of the rest of them. Instead of having one business card that you're using to buy everything and sign up for all the subscriptions in your business, and then one of those vendors gets hacked and you lose that card number, now you have to go in and change the card number for all of your vendors, for all of those subscription services. And that would be pretty annoying. That might also cause some problems in your business. You might have some subscriptions that went unpaid, or you might have some bills that didn't get paid because you had to shut down that credit card. So using an expense management platform helps alleviate a lot of those issues. It also allows you to delegate spending authority to employees. You can create budgets that have spending limits on them. You can also create cards for your employees that have spending limits on them. For example, you might have an employee who's getting ready to go to a conference. That conference is related to the work the employee does, so the business is going to pay for it. You want that employee to be able to book her hotel room, buy her flight ticket, eat food while she's gone on that trip. So you want to give her the ability to spend money, but you don't want to give her the corporate card. You don't want to give her access to the business's treasury. So you could create a card that would put a daily spending limit on it, such as $200 or $300. You could assign a card to your administrative assistant or your virtual assistant and let your VA purchase the hotel room and the flight tickets for that employee. Instead of handing the corporate card around to everybody, and now everybody has the code, the CVC code, the expiration date, and anybody could be using that credit card number for anything. Now you've assigned a specific card to the different people that are involved in all of those transactions. You can even create a single-use card, or what we would call a burner card. You could create a card that could only be used by the VA to buy those airplane tickets, and then that's the only purchase that would be allowed on that card. As soon as that purchase was made and cleared, that card would no longer be usable by anyone. It gives you a lot of control over spending without actually having to be the one doing the spending, without actually having to be the one that's inputting the card information into the website that you're buying from. I really like having an expense management system, even if you have a very small operation, even if it's just you and maybe one or two other people. If you have a VA, or if you have an assistant, or if you have a business partner, or if you have a spouse that also occasionally makes some purchases on behalf of the business, it makes it really easy to delegate that spending authority to them without having to worry about anyone having access to the business's funds or the business's entire credit limit. Never, ever, ever let an employee or anyone else use the unlimited business card or corporate card. Never give anyone else access to the business's entire credit limit, or especially the business's cash. A line of credit is a group of products, but I'm going to leave credit cards out because I've already talked about them. A line of credit offers access to funds without needing to take out a loan. It is a type of revolving credit product. In other words, instead of a set amount of money that is then either transferred to you or is used to make one single purchase, like buying some property, instead a line of credit is an amount up to a credit limit that you can draw on to spend. This allows you to borrow money when it's needed up to that agreed upon limit. It's usually at an adjustable interest rate. So one thing that's true of credit cards as well as lines of credit is that the interest rate is rarely, if ever, locked in. You rarely have a credit card where you've locked in that interest rate for as long as you have that credit card. It can change. It can vary. The institution that issued that product, that issued that card, that line of credit, can change the interest rate at any time. Usually with a loan, especially with a mortgage, you can have a fixed rate option, which means that whether interest rates go up or down, or future customers use those products, the exact same product in the future, they sign up for the same credit card or they take out the same kind of loan, they might have a different interest rate because rates changed from the time that you took your loan and the time they took their loan, but the rate on your loan will never change. With a credit card or a line of credit, you have an adjustable interest rate, which means the interest rate changes and can change all the time. With the line of credit, you have the flexibility of being able to draw on that cash for not any particular purpose, but at the same time, you have the adjustable interest rates. You also have a credit limit, and you can't borrow more than that. Sometimes they'll let you borrow more than that, but either at a significantly higher interest rate or they'll have a finance charge attached to any amounts that you spend above that credit limit amount, but that's pretty rare. Lines of credit often have lower interest rates and higher credit limits than credit cards. So even though credit cards are a kind of line of credit, there's usually a differentiation in those two products. And again, a line of credit is a little bit more difficult to get than most credit cards are, even business credit cards. Usually a line of credit, you have to have some credit history. You have to have some history of the business being open. Usually a line of credit for a business isn't available in the first few years at least. You also have to be able to prove and demonstrate that you have the ability to service that line of credit. If you have a P&L that shows that you've never really been profitable, then a bank's probably not going to give you a line of credit. If you have a P&L that shows that over the last 3, 4, 5 years, profits have been growing, the business has grown, you can show them a balance sheet that shows that the business has some assets, you can show them a statement of cash flows that shows that cash flow has been steady, then you're more likely to be approved for a line of credit. And that line of credit might be a lot less than what you were hoping for. You might be going in asking for a line of credit of $100,000 and only get approved for $50,000. Banks are, depending on how the economy is going, based on how interest rates are going, banks are going to be more or less skittish when it comes to issuing debt products to businesses, especially bank products that have longer terms and lower interest rates. And that's exactly what a line of credit is compared to a credit card. So it's usually much easier to get a credit card than it is to get a line of credit, even though lines of credit tend to have better interest rates and higher credit limits than credit cards do. But just like a credit card, a line of credit is unsecured debt, meaning that there's no collateral there. So when you take out a loan or a mortgage from a bank, usually there's collateral. Usually there's something that if you default on the loan, if you stop paying the loan because you can't pay it anymore, there's something, usually some piece of real property or some piece of equipment or machinery that the bank will come take in exchange for canceling that debt, or at least writing off a portion of that debt. This usually happens with auto loans, for example. So if you stop making payments on an auto loan, then the bank will repossess that car. They'll take possession of that car back and use whatever they can get from that car to offset the amount that you owe. With real estate, we call it a foreclosure. The bank will foreclose on the property, meaning they'll take it from you. You can't live in that house anymore, and they'll use the proceeds from selling the house to write down the debt that you owe. With a line of credit or a credit card, there's no collateral. So all the banks can do is keep coming after you, trying to get as much cash from you as you can if you stop paying on that line of credit or credit card. That's why the interest rates tend to be much higher. It's also why the credit limits tend to be much lower than for a loan or a mortgage. Now, for traditional loans, as well as government-sponsored loans, you tend to have to go through banks. The application process tends to be longer. These are usually for established businesses, with some exceptions, but you tend to need to have collateral for these kinds of products. You tend to need to have something that the bank could take other than chasing after you for cash if you default on the loan. Loans are usually not available for smaller, newer, and really service-based businesses because those businesses tend to not have collateral. There are some government-sponsored loan programs, such as the Small Business Administrations, or SBA's 7A loans. They also have a set of products called microloans that offer access to capital with more favorable terms than you'd find going directly to a bank. Eligibility for these is based on a lot of different criteria, including your business size and its sector. But again, getting a loan as a small business, especially if you're a service-based business, is going to be incredibly difficult. So credit cards and expense management platforms, which use credit cards as part of them, maybe a line of credit, but really credit cards is where you're going to have the most luck as far as a small service-based business goes in establishing credit and being able to use credit in your business. If you have debt or you start using debt to finance your company's operations, you need to make sure that you're not relying too much on it. You don't need to become dependent on debt to finance your business's operations. You want cash flow. You want profit financing your business's operations. If you're becoming too reliant on debt, then you run into the problem of potentially not having enough cash flow to service that debt. And if you had a creditor or even an investor come asking for their money back, if you have a creditor close your account and demand payment, or if you have an investor that wants to sell out, you may not have the funds available. You probably wouldn't if you're too reliant on debt and therefore have not been managing cash flow well. Looking at your business's financial report can provide you some quick insight about your company's debt position. There are 3 ratios in particular that I like to use with my customers and that are also pretty widely used by investors and lenders when looking at companies in terms of how dependent they are on debt. The first one is pretty easy. It's the debt to equity ratio. This essentially measures a company's debt compares to its equity. When you look at a company's balance sheet, there are 3 sections: assets, liabilities or debt, and equity. Assets are what the business owns, liabilities are what the business owes, and equity is the difference. It's what the owners actually own of those assets. A lot of people will also call the equity section net assets, which is assets minus liabilities. So if you think about it that way, net assets or equity is all of the assets, what the business owns, minus what it owes, its debt, its liabilities. If you have too much debt relative to assets, then you'll have very low or maybe even negative equity. That's a bad situation to be in. If we're comparing debt to equity, we're comparing how much of the assets of the business are owed to creditors as opposed to owned by investors and owners. So a higher ratio indicates more reliance on debt. Remember, creditors get paid first. If the business goes under, the creditors get paid first. Another way to think about equity or net assets is if the business were to go out today and all the creditors were paid, how much would be left for the actual owners, for the investors? If you have a high debt to equity ratio, there's not going to be as much as if there were a lower debt to equity ratio. It's also an indication to potential creditors of where they stand in the pecking order. So if the liabilities are relatively high compared to equity, then it's going to be more difficult to convince a new creditor to loan you even more money, because the older creditors, they're going to get paid first. The newer creditors are going to get paid next. If there's already a lot of debt on the book, especially relative to equity, then it might not be very enticing to a new creditor to want to extend you a loan. There's also the interest coverage ratio. This one tends to matter less for small businesses, but it's still important to think about. The interest coverage ratio calculates how easily a company can pay its interest expense from income generated from operations. It's essentially either net profit, or usually we see EBITDA used here, maybe even EBIT, earnings before interest and taxes. For most small businesses, EBITDA doesn't really make a lot of sense here, so normally we're talking about net profit. So what's the ratio of interest to net profit? A higher interest coverage ratio, or ICR, indicates that the business has plenty of resources to cover interest costs. If you've got $100,000 of profit and only $5,000 of interest expense, then you're looking at an ICR of 100 to 5 or 20 to 1. That's pretty good. If you're looking at profits of $50,000, whereas if you were looking at a business that had, say, $25,000 of net profit versus $5,000 of interest expense, now you're looking at 5 to 1 for an interest coverage ratio. That's getting pretty dicey. That's a significant amount of net profit that needs to be reserved in order to go to interest expense. That is not going to leave much margin for repaying the principal, which means there's really not going to be much left for an investor. That's what creditors or investors are worried about when it comes to the interest coverage ratio. Anything below 10 to 1 is going to be very suspect. Anything over 20 to 1 is going to be considered pretty normal and not too bad. There's also the quick ratio, and this is a pretty commonly used ratio, especially when it comes to looking at short-term debt. The quick ratio measures the liquidity of a company by comparing short-term or current assets against short-term or current liabilities. Remember earlier on, I said you need to record the short-term or current portion of your long-term debt separately. You need to take the next year's worth of principal repayments for loans and mortgages and show that as short-term debt on your balance sheet, not as long-term debt. The quick ratio looks at your current assets, essentially cash. Maybe we include accounts receivable in there, since accounts receivable is essentially cash you expect to collect within the next year or so, hopefully quicker than that. And then we divide that by your current liabilities. Current liabilities is your credit cards, your lines of credit, the short-term portion of any longer-term debt that's due. What we're looking at is, do we have the cash, and will we have the cash over the next year to pay down and pay off all of the debt that we'll need to pay over the next year? You're looking for a quick ratio of at least 1. You really want a quick ratio of more than 1. 2 to 1 is okay. 3 to 1 or above is good. You want to make sure that the business has enough cash, including the cash that it should collect from accounts receivable, in order to cover all of its upcoming debt. So when determining which type of debt is best for your creative agency, be sure to weigh all the pros and cons carefully. Like I said, you're most likely going to be eligible for some credit card products and probably not much else beyond that. But some businesses, depending on how long you've been operating and depending on how large the business is, you might qualify for a line of credit. You might even qualify for a business loan. If you do, take into consideration all the pros and cons and really consider whether your business needs that debt and whether your business really plans to be able to service that debt. Just remember that responsibility here is key. You are responsible for covering that debt. You don't want your hard work taken away from you, and meaning your business, because you didn't handle debt correctly. Thanks for listening to the Jay Well CFO Show. I hope you found this episode helpful and informative. If you have any questions or comments, please feel free to contact me or leave a review on your favorite podcast platform or here on YouTube. Until next time, take care and keep growing your creative firm.